Jitendra Shriram, Director and Head of Research with HSBC Securities, joins us live. Jitendra, good morning and fantastic to have you back. Now, Jitendra, we can blame yesterday's selling on Syria, S&P or rupee, but the bottom line here is that Indian markets are in a pronounced downtrend and the sentiment is so fragile that a strong comment on India and Indonesia from S&P has really spooked us.
Yeah, India depends and is very vulnerable to external capital flows, and this is what makes this situation all the more vulnerable. Do remember that India is on the cusp of being an investment grade nation. So to that extent, even a one-notch kind of a potential downgrade could put us very much into the junk grade, which obviously has implications in terms of sovereign wealth funds or in terms of pension money coming into India. So it's very critical that we retain our current ratings.
Jitendra, are we close to a bottom though, or do you think we can actually crack below last time's low of 5,200 as well, and we could see relentless selling in the current wave?
Well, there are two things. See, one is purely from an aspect of the QE unwind. Now, clearly, 2009 onwards till 13, there's been a lot of flows that have come into India. And from that perspective, if an unwind does come in, I don't think we have even seen the tip of the iceberg in a sense, even 5-10% leaving. So, I'm not saying everything will leave, but even if there is a reasonable, unwind of all this money, you could see some money leave Indian shores. So, to that extent, it will leave us vulnerable. Second is also, we need to also get a grip on our own finances. In a sense, I think there's been too much blame game on the external environment. The fact is the epicenter of this entire problem, which was the US and the periphery of Europe, they are probably at a far better shape than what we are today. So we can't keep blaming them for it because the Dow is actually at close to a lifetime high in that regard. So the blames are our own, the problems are our own, and it's all mostly self-inflicted issues that are causing it. I mean, just to put it in perspective, something like a food security bill takes away all the good work that we've done over the last 12 months in terms of fuel price increases. So, with one stroke, we are back to zero again in terms of all the deficit reduction that we manage. So first is we need to get a grip on the fiscal deficit, then on the current account deficit, and that's when, investors will be enthused to put money back into India.
Jitendra, exactly 6 months ago, or I would say exactly 8 months ago, Axis Bank had raised about $1 billion via the QIP route at 1390, and that QIP issue was more than fully subscribed. Investors were jumping on top of each other. Everybody wanted to buy shares of Axis Bank from the QIP. Now in less than 10 months, those investors are simply smashing the stock down. So what has changed?
Well, I think one of the key things has been this entire aspect of monetary tightening, which was an unexpected factor from the RBI. The kind of moves that came in since July for the entire banking space has been quite a surprise. Short-term rates have moved up. I don't think anybody was forecasting this level of hardness in even T-bills or G-Secs and so on. And obviously that's had an impact on the entire banking sector as a whole. And the fact that, market is now forecasting like a sub 5% growth means that, asset quality issues are going to get stickier in that regard. Now, that is one part. Second is also this whole aspect about the SOOTI stake sale, which is gathering momentum. Given that government is in a bit of a crossroad in terms of trying to meet both ends meet on the fiscal situation, it raises the probability of, a SOOTI stake sale much more higher. And in that regard, again, Axis is far more vulnerable given the large amount of stake that resides there with the erstwhile UTI 64 scheme.
Jitendra, what explains the kind of move that we've been seeing with IT Pack? And I mean, even yesterday you had the likes of a Tech Mahindra or a Hexaware actually holding out. Do you think smart money is going to continue to chase these names?
Well, there are two tailwinds. One is the earnings upgrade that is coming through from a weaker rupee, and as you saw, rupee wobbling in yesterday's PM trade. I would expect that the tech sector will continue to see earnings upgrades coming in because the market is still catching up with the new norm for the rupee. So that's one major area of uptick that is coming in. Second, I also sense from a lot of investors, and this is particularly true for both the IT and the pharma sectors, that they are looking for DM plays as well out of emerging markets. And both these sectors actually fit the bill because bulk of their business comes from developed markets. So to that extent, it is a way of playing the DM trade out of EM stocks. So I think both these facets are clearly at play when you're looking at IT and pharma as a sector.
Jitendra, but do you think this weak rupee trade for IT is getting slightly frothy? Yes, IT companies will benefit because of a weak rupee, but that gain will be only one time. Eventually, business dynamics will take over.
Well, the fact is, where do you peg the new norm for the rupee? Whether it's maybe early 60s, probably then I would say that, at least the IT sector has got a new lease of life in terms of margins for at least the next 5 years or so. So to that extent, there is a re-rating of the sector that's coming in. I do understand and do take your point that, maybe there has been a little bit of an overshoot near term. But the fact is, near-term earnings obviously will get a boost because of this weakness in the rupee. The other part is also that, till we get a considerable hold on our current account deficit, I don't think this trend on the rupee or rupee remaining relatively weak compared to the dollar will unwind very soon. So that continues to be a big supporting block for the IT sector as such.
If Nifty for this financial year closes above 5,000, would you say that that is a victory for the bulls?
That's a tough one. I would expect that, definitely market from a valuation perspective is now at least trading at a reasonable enough valuation. See, short-term aberrations, there is nothing which prevents a market from trading below fundamentally merited valuation for some period of time. And that could well happen in a situation of a QE unwind. And it's very, very possible that, we continue to drift below fundamental value. But I would still say that the fundamental value of the index is probably closer to that 20 to 21,000 range rather than, where it is today. India has long-term growth, which is still there. We have short-term problems and we have a situation where, we need to desperately get a grip on the fiscal situation. But I'm not a bear on the long-term fundamentals of the Indian economy. Right.
Jitendra, the large cap end of the market in last 2 weeks or the last 3 weeks has got clobbered. But mid and small cap stocks have stopped falling. Do you think now it is time to look outside Nifty 50, time to look outside Sensex 30 because those stocks are looking cheap, those stocks are looking attractive, and whenever economy will turn around, because one day it will turn around, mid cap stocks will recover, faster than large cap stocks?
Well, I think in the last 3 years, clearly the extent of correction that has taken place in the mid-cap and the small-cap universe has been far more profound. So I do agree that, price levels have become a lot more attractive in that space, and, you get really bargain prices in a lot of the spectrum of stocks that are available in this universe. And by corollary, what is happening in the large cap spaces, this has been the part of the corner trade. In a sense, a lot of foreign money has logically flown into the large cap universe as such. And when there is a risk of probably a QE-led unwind coming in at some point of time, there is clearly more selling to be seen in the large caps than in the mid and small cap universe because ownership levels are anyway quite low. Now, that is the flow perspective to the whole equation. The second part of the equation relates to what is happening near term in the economy. And here I would say that if I look at, say, a Nifty and probably if I look at a mid and small cap universe, I still see a difference in terms of the fundamentals. Nifty, for example, average debt to equity as per FY13 annual report would be somewhere in the region of the mid-70s. Whereas if I look at the mid-cap universe or the small-cap universe, debt equity is still upwards of 120%. And that would still prove to be a headwind for the mid and small-cap universe from an earnings perspective. Given the short-term tightness in rates that you're seeing, given the lengthy working capital cycles that we are currently in, I would still say the fundamental story probably for the mid and small-cap universe is still not very positive. So it is, I would agree there are some pockets that one can look at, but I wouldn't go out and buy the whole basket there because I think the near-term earnings will still continue to be facing headwinds.
Jiten, what's the sense on autos given the kind of mixed bag that we've seen when it comes to the monthly sales data this time around?
Well, overall, I would still continue to be cautious on that sector. The main reason is, you are seeing the impact of increased fuel prices. Customers obviously tend to postpone discretionary purchases when you are in a situation of a slowdown, and those trends are evident in the monthly numbers. So, I would definitely be very, very selective. Maybe two-wheelers as a spectrum may not be as impacted as, say, the cars space would be. So one needs to be very selective because discretionary spending will take a knock, and I would suspect that even pricing levels will move up. So in cars probably the imported content will be a lot higher, which will start seeing the impact of higher rupee dollar costs come into the equation, raising prices of vehicles overall.
Jitendra, so where is opportunity in this kind of an adversity? Best trades are always made when there is outright gloom and doom. So at the current juncture, what are your classic long-term ideas? Which are the stocks you're recommending your clients that they should buy for the long haul?
Well, one is clearly, as I mentioned earlier also in the show, IT and pharma from the earnings perspective will continue to see uptick in terms of earnings momentum. Secondly, I would say if you want to position yourself for a recovery, I would argue that, people who have already got their assets on board and where utilization is the only kicker that you need to wait for. So you don't have to take too much of project risk issues on the books is where one should be starting to focus on. And in our India topics, we clearly have some names which fit the bill, like, names like Petronet LNG, something that appeals to us, something like an ILFS transport appeals to us. So these could be pockets, which are probably positioned far better for a recovery than in terms of, trying to play something which is hugely leveraged and you still run the risk of higher short-term interest rates impacting financials.
What else is it that, Jitendra, you're recommending to your clients right now? Is there something which is looking extremely mouth-watering when it comes to the valuations and would be a good buy even in this market?
Well, utilities is a space we clearly like. That is because of the kind of reforms that is taking place at the state level, the FRPs that are kicking in. I would suspect that, that's a space where valuations have clearly corrected and you have a situation where probably on the ground fundamentals are starting to look up. So that's one sector that we do like. Second, I would say energy sector overall is starting to look very interesting, and that is an area, the main reason being that a lot of the revenue there is completely dollar denominated, especially for the upstream companies. And market has probably mispriced them to some degree, clubbing them with the local industrial players and so on, and hammered these stocks as well. And so this segment of the market is again starting to look interesting. Names like Oil India, ONGC, Kane, all these are starting to look very interesting.
Which is one government action stroke policy reform you're confident of and which could have a meaningful impact on stocks?
Well, I would say it's not going to be one specific thing because, if I look at various moves that have been taken so far, I would suspect that, you need to probably raise diesel and petrol prices materially. Gone are the days where we can be satisfied with half a rupee and 1 rupee increases there. You probably need a one-time adjustment of 5 to 6 rupees, which would make me positive that at least, government is serious about fiscal consolidation. Again, it's gone are the times when, mere commentary will suffice to satisfy markets. You need probably real action to merit that kind of comfort that the government is serious. So you need those kind of actions probably to make sure that people come back saying that, okay, there is something genuine afoot.
Jitendra, good having you on the show. Really appreciate you taking the time out and speaking with us.